If the Bank of Canada cuts interest rates, does that mean fixed rates are going to go down as well? Nope. Wait, why not? It's because fixed rates are based on bond yields, not the Bank of Canada overnight rates. So what does that have to do with mortgages? Think of it like this. The government also needs to borrow money. They do so by selling bonds to investors, and investors get a yield, aka the interest rates. Banks can loan money to individuals like me or you in the form of a mortgage, but they can also loan money to the government as well, which is the risk-free rate of return, because the government can always just print money to pay off the debt. Got it. So when the Bank of Canada cuts interest rates, it doesn't always impact the bond yields. So let's say that the bank lends money to the government at 3%. That money is the risk-free rate of return. It's guaranteed. Instead, they can lend money to us as well in a mortgage, and there's much more risk to that because we could default on the loan. We are not risk-free. Also, on top of that, it's more expensive for the bank to loan to us because they're going to have to pay commission costs. They're going to have to pay for maintenance, for technology, for people to reach out and maintain the mortgage. It's a lot more active work, and as a result, they deserve a higher rate for lending in the form of mortgages. So that's why if bond yields go up, that means that fixed rate mortgages tend to follow up as well. So then what does impact bond yields? So the Bank of Canada rate cuts directly impact variable rates. It doesn't always directly impact fixed rates. The Bank of Canada makes a rate decision often on what's happening now, whether that is inflation, job losses, or what's going on in the economy or the global macro environment. Bond yields are often driven by investors, but can also be impacted by the government and to some extent also the Bank of Canada. Basically, they're more forward-looking. So it's going to be based oftentimes on where investors see long-term economic growth, inflation, the economy, global macroeconomic factors, and all of these will go into determining the price of a bond yield. Also, when the Bank of Canada cuts rates, that in itself may not change bond yields. However, their forward guidance, in other words, what they're saying at the meetings, may impact bond yields. Remember that bond yields are forward-looking. It can be based on 3, 5, or even 10-year outlooks. Awesome. How do you know so much, and how could I stay informed on this? Yeah, you can just follow this channel right here to keep up with more real estate news and content.